What if the global financial system isn't just straining under stress, but is already? Look at your portfolio, the stocks, the real estate, the digital assets. You think you are wealthier than you were a decade ago. But legendary macro investor Ray Dalio warns that we have collectively fallen into a psychological trap. We have confused wealth with money. Right now, the United States is spending $7 trillion while pulling in only $5 trillion in revenue. This structural deficit isn't just a political talking point anymore. It is an economic cardiovascular disease. The plaque has filled the arteries of the global reserve currency. And according to Ray Dalio, we have officially crossed the line of no return. The collision between uncontrollable debt and a hyper-leveraged asset bubble is locked in. Listen carefully.
Ray, are we already past the point of no return? That the fact we have this dynamic means that some sort of crisis is inevitable?
Yes, we're past the point of no return, meaning when debt service payments squeeze out spending, like plaque in the circulatory squeezes out the flow of money, the flow of blood, it's the same kind of thing. It can be measured. So we're seeing that happen.
Most market participants are trapped in outdated, linear thinking. They assume that as long as the federal government can issue bonds, the system can stay liquid forever. But they misunderstand the basic mechanics of supply and demand. When a government runs a multi-trillion-dollar deficit, it has to flood the market with treasury bonds. But who is buying them? Institutional hesitation is quietly hitting a fever pitch. Central banks and global sovereign wealth funds are looking at the negative real yields of Western debt and pulling back. This sets off a dangerous chain reaction. When the supply of debt vastly exceeds demand, bond prices collapse, forcing long-term interest rates to march upward. This isn't just about numbers on a screen. It is the breakdown of the foundation upon which all global capital is priced. We are staring down a structural breakdown that history tells us always ends in one of two ways: outright default or aggressive currency devaluation.
And then there's a supply and a demand issue. The supply of one budget deficit means that debt has to be sold, and you have a supply-demand issue. And we could see it happening in the bond market, and we could see that bonds have been a bad investment, and that there's pressure in interest rates and there's borrowing. And that's one of the five factors, as you're saying. But that dynamic is happening. People are treating it like if it hasn't happened before. They don't understand that, like plaque in the arteries, that it builds up and they have that exposure.
As this dynamic accelerates, the tension spreads across the entire macroeconomic landscape. Traditionally, a central bank could lower interest rates to rescue a faltering economy. But the Federal Reserve is now trapped in a vice. If they cut rates to ease the government's mounting debt servicing costs, they risk reigniting inflation. If they hold rates high to fight inflation, they push the government into a sovereign debt spiral. This brings us face to face with an unavoidable monster: stagflation. When long-term yields break higher, despite the central bank's actions, capital flees traditional financial assets. We are already seeing the warning signs. Capital is moving out of the fiat ecosystem and into hard assets like gold. But for a modern financial world, this macro environment changes the entire thesis for Bitcoin. Bitcoin is no longer behaving like a speculative tech stock. It is maturing into a non-sovereign, hard-capped liquidity sponge. As institutional capital observes corporate treasuries mimicking companies like MicroStrategy, and Wall Street pumps billions through spot Bitcoin ETFs, the underlying supply dynamics are reaching a tipping point.
The bond temper tantrum is finally occurring.
Well, it could be seen, excuse me, in either the bond market, the market action. It's by long rates rising relative to short rates. In other words, they're trying to hold the short rates down, and the long rates are rising.
And we are seeing some of that.
and you're seeing the weakening then of the dollar, and then you're seeing movements such as in gold and other assets.
When the sovereign debt market begins to fracture, that pressure immediately transfers to equity markets. The historical illusion that stocks can endlessly go up while the bond market burns is about to shatter. The equity risk premium is compressing. Investors are realizing that the prospective returns on highly valued stocks no longer justify the risk when risk-free bond yields remain elevated. The central banks find themselves entirely powerless to stop this rotation, because you cannot print your way out of structural asset scarcity.
And when you see that rise in rates, then that starts to affect the stock market, because what's happened now is that with bonds going down and stocks going up, the prospective returns now of stocks are now down low relative to the prospective returns of bonds. And so that upward pressure then starts to translate into a stock market pressure. That is the classic dynamic, and something that the Federal Reserve then, or any central bank, is in a position of not easily being able to manage.
If Dalio's thesis plays out fully, the consequences will reshape global wealth distribution. When a government cannot afford its own debt payments, it resorts to a historical playbook known as financial repression. Instead of allowing the free market to price interest rates, the state steps in to artificially suppress bond yields below the rate of inflation. They force domestic institutions to hold government debt, implement aggressive taxation on capital gains, and historically, they even place capital controls to prevent money from leaving the borders. Financial repression is a stealth tax that transfers purchasing power from the saver directly to the sovereign debtor. This is precisely where the divergence between the old financial system and the emerging digital paradigm becomes absolute. In the 1930s, the state could simply outlaw gold and force citizens to hold depreciating cash. Today, capital has an exit hatch. A global, borderless, mathematically fixed network like Bitcoin cannot be easily trapped behind domestic foreign exchange controls. As the reality of forced negative real yields sinks into the institutional psyche, the narrative shifts from "should we allocate to crypto for upside?" to "how much global capital must we migrate into decentralized infrastructure to ensure survival?"
Do you think we head to the 1930s again, where it's a treasury that works with the Fed? That some of that independence is kind of chipped away out of a necessity to keep debt servicing costs low, for example?
I think it's exactly headed to that kind of thing, which we also saw a number of times through quantitative easing. It's called financial repression, and the idea is that you drive the bond yields down with buying of assets and so on. Sometimes it includes even foreign exchange controls to try to prevent money from going outside the country and so on, but to have that forced low real rates. And then that's usually accompanied by high taxation and a higher level of inflation to bring in revenue. And because money wants to go to other things, that's when gold has been illegalized, that's when foreign exchange controls come in, and so on and so forth.
This brings us to the core of Dalio's warning. The mechanics of how this massive asset bubble actually pricks. The tech landscape, powered by the AI revolution, has created a historic disconnect between perceived corporate wealth and real liquid money. We see multi-billion-dollar valuations created out of thin air via equity offerings and venture capital leverage. But you cannot buy food, raw materials, or sovereign security with illiquid equity valuations. You can only spend money. The pricking of the bubble happens the exact moment investors are forced to convert their theoretical paper wealth into cash to meet real-world obligations, whether that is debt service, corporate expenses, or wealth taxes. When everyone rushes for the exit at the same time, they discover the liquidity door is incredibly narrow. Add to this volatile mix the geopolitical pressure cooker. The global paradigm of U.S. hegemony is fracturing. If global supply chains are disrupted, whether through conflicts surrounding Taiwan or maritime bottlenecks like the Strait of Hormuz, The artificial wealth holding up Western equity markets could evaporate overnight.
And so wealth, you cannot spend wealth. Wealth is, you have to sell wealth to get money because you can only spend money. So when there's a lot of wealth relative to the amount of money there is a vulnerability, and bubbles burst when wealth needs to be converted into money.
Well, what is the trigger for that?
Often that's because of debt, but it could be for anything. It could be for wealth taxes, for example. Supposing you put in wealth taxes, then those people who have wealth are going to have to sell some of that wealth to pay taxes.
We are climbing toward the same over-owned, hyper-sentimental bubble territory seen in 1929 and 2000. But unlike those eras, the central bank doesn't have a clean balance sheet to absorb the blow. When the necessity arises to convert paper wealth into hard money, capital will desperately hunt for an asset that has zero counterparty risk, cannot be diluted by emergency printing, and is highly liquid worldwide. This is the ultimate macroeconomic bridge to the hyper-monetization of Bitcoin.
Yeah, is it a bubble that bursts eventually?
So I think it is, yes. And then that moment, there's always the issue of a bubble, and we can measure a bubble. I have indicators, and there's how many people are overowned, what's the sentiment, a lot of indicators for bubble. And we are right now rising closer to, not at, the same level in 2000 and same level in 1929.
Is there a specific level where you say, oh no, here's the one that we really need to worry about?
The thing about it is there's two parts to it. There's, quote, a bubble, and then there's the pricking of the bubble. And the pricking of the bubble happens when there's a need for wealth to be sold to get the money.
The financial elite are telling you exactly what is coming. The debt is unsustainable. The systemic plaque is hardening. And the historical playbook of financial repression is being dusted off. Most investors will spend the coming years trying to protect their wealth using the exact financial products that the state intends to inflate away. But what if the market is entirely wrong about the timeline? What if the pivot out of fiat and into undevaluable digital infrastructure happens much faster than the consensus expects? When the music stops and the desperate dash from paper wealth to real money begins, those who stayed behind in the crumbling legacy architecture will learn a brutal lesson about the true cost of systemic trust. The exit door is shrinking every single day. The only remaining question is, which side of that door will you be standing on when the bubble finally pops?